Hey, welcome back to Two Super Guys Trade Sucks. I'm Dylan.
And I'm Vinny. And man, oh man, this week has been interesting. We're getting a lot of details on this one magnificent large bill that Trump has been putting forward. I'm not going to talk about the details of the bill itself. That's not really for this channel. But I want to talk a little bit about U.S. national debt and what this bill aims to add to it and where the music stops on this merry-go-round of debt for the United States, possibly. All right.
Okay,
We'll get to the
which
video here.
very scary because it's unsustainable right now. So
Yeah, yeah, yeah. Spending is been a very bipartisan thing. Also, like randomly of note here, I actually used ChatGPT for the first time ever to generate this image here. I just like give me a political cartoon of the stock market crashing, Trump sitting on debt, and just people in despair everywhere. And like this is what AI generated for me in a matter of like 2 minutes. Pretty wild.
yeah, it's crazy, man. It's pretty awesome.
All right. So the headline here is that this one magnificent large bill has passed the U.S. House, right? Moving on to the Senate for reconciliation and then final negotiation there before sending it off to Trump to be signed. The estimates are this would add about $3.8 trillion to U.S. debt. Right? There's a great podcast. I'm trying to remember I want to say it's from Freakonomics, where they interviewed an economist that had written an op-ed that was basically what are the 10 things conservatives get wrong about taxes and what are the 10 things like liberals get wrong about taxes. And it's pretty interesting. Like, the whole mantra about like, oh, tax cuts pay for themselves is not true. That's one of the ones the conservative ones get wrong all the time. So this is going to add 3.8 trillion is the estimate to the U.S. national debt. Right?
Now, is that just for this specific bill by the end of 4 years?
Yes. Yeah, not in 4 years, over 10 years.
Over
They
10
always do
years.
that number to get a little bit bigger. But over the next
Okay,
decade, they expect $3.8 trillion in additional national debt because
okay,
of this bill. All right.
over 10. Got it.
So where are we from like a debt perspective here? You actually have to move me over in order to see this.
Yeah.
It's a big, big killing number, north of $36 trillion. All right. But when you're talking about this, you have to put it in context with GDP. And there's also the fact that you really should eliminate intergovernment debt because that's not really debt. It's debt held by the public that matters more. We'll talk about that here in a minute. Um, so, as a result of this looming large kind of commitment to expenses here, with a decrease in revenue expected from the tax cuts portion of it, we're looking at a last credit agency downgrading the U.S. government from AAA. We saw the ripples to the market this week. I don't know if you're going to talk about that in regards to TLT at some point,
Probably next week.
but we saw some yields move, right?
Yeah, yeah, they're way too high. So in the video tomorrow, I'm going to talk about mortgage rates, which obviously this did not help mortgage rates at all.
Mhm.
But yeah, it's not good. Very bad.
Exactly, yeah. And this is largely symbolic at this point, as most kind of credit rating companies were well, two of the three major bureaus had already downgraded the U.S. government. This is like let's say the last remaining one, but we were kind of getting priced at this AA plus like range rather than triple A. There's like 23 credit
There's
grades,
so
which is
many.
pretty wild. Um, but you're now seeing interest expense surpassing the U.S. military, which was, other than entitlement programs, the largest budget item for the federal government on a yearly basis, which is pretty wild. Um, Bob, this is what they're looking at for 10-year Treasury yields. Not significantly from where they've been for the last, year almost, but still pretty far from where they were back during the pandemic, right?
Yeah, it's
Yeah.
it's not sustainable when you look at average salary, how many houses now. I'll talk about tomorrow, but it's not good.
Yeah.
Let's just go with that. It's very bad.
And this is what you're talking about the two mortgage rates
Yeah,
here.
it's so
Bump
bad.
back above 7% for a 30-year mortgage rate. Yeah, part of this was already in play, but this is certainly accelerating things. All right. So now we're going to talk a little bit about U.S. national debt compared to GDP. So this is a great chart as of 2023, showing how levered all these countries around the world are. And you see that there's only a handful that are really over this 100% number, which is where the U.S. is, or approximately 100%, depending on whether or not, like I said, you exclude intergovernment debt. there's not a lot of countries that are able to sustain this for a long, long period of time. So the question is, when does the music kind of stop for the U.S. and we can no longer continue to refinance our debt? Because we're already seeing, like I said, that it costs us significantly. We're talking about $1 trillion a year be spent just on maintenance of this debt at this point. So this is a chart here looking at the ratios of the GDP to the debt or debt to GDP. So if you notice the really wild one here is Japan. Look at this, takes off and has been kind of chilling up here in the 200% range. The United States is right around hovering right around 100%. So we would have significantly longer to go before we get to Japan status. But Japan's economy has been struggling for 30
Yeah,
years now,
not good.
and it's not a place we want to even begin to
That's
approach.
it's not something we want to strive for, right? It's not a good argument for someone to be like, well, Japan's is 200, so we're
Yeah,
fine. Bad argument.
exactly.
That's not good.
Yeah. So this is from a kind of a research paper that was, or op-ed, I guess, based upon research that was published. I can't remember the school of management. It's I want to say the is it Wharton School of Management, maybe, Pennsylvania State, very well respected economic forum here, and their estimate is that public debt cannot exceed 200% of GDP, even under the best of circumstances. Right? This is where they talk about the elimination of intergovernmental debt, where 6.8 trillion of that debt is owed by the U.S. to itself, which is brilliant.
Perfect.
So they actually put the GDP ratio closer to 98%, so right around 100%. And this, like I said, the 200% number here, as far as what we can tolerate, is based upon the best case scenario. So if you were to actually go like, what can we realistically tolerate if we happen to run into it during a down economy? Their estimate is closer to 175%. So we actually still have, unfortunately or fortunately, quite a room to run here, right? We're not
Well,
coming up to any sort of, level where things are unsustainable, but we will eventually. The course that we're on certainly takes us to that town, if you will, that city you don't want to visit. But it's 20 years is what they estimate in terms of time before we run out of options.
so I do think I don't know how to like not get political. Okay, in my opinion, I do think the train that we're on is unsustainable because when you look at that number, that's factoring in like what 20 years to get to 36 trillion of debt. What are we at?
No, so like I said, if,
Thir-
if you back out that 30, this is saying 33, 20, so closer to 26 trillion of actual debt held by the public,
right.
based upon current GDP levels, it'd be over $50 trillion in debt. Now,
So,
you also have
but
to account for the fact that the U.S. economy GDP will be growing about like 3% per year during that time period as well.
true. But let's take that 50 trillion number. We added 8 trillion in 4 years.
Hmm.
That's a problem. That's not good. That's way too much.
Yeah,
So if they're saying that this bill is going to add 3.8 trillion in 10 years and that's it,
yeah.
no more
Hmm.
than that, that's not near as bad as
Agreed.
yeah. I
Yeah,
don't know. Trying
we're
to
not heading towards cataclysmic levels here. Yeah, it's kind of my point here. Despite what we saw the market panic a little bit this week with that last downgrade, the point I wanted to make is that it is very much a bipartisan thing right now to
yeah.
spend more than we take
Yeah.
in.
Both sides.
It's just buying votes and destroying future
They're,
generations.
yeah, it's a terrible idea. We need an accountant. Would be great. Just an accountant as president. That'd be fantastic.
Oh, yeah. That'd be amazing, actually. Tim Cook for president. I don't even know if he's got an accounting background, but he certainly is a one hell of a manager. Um, the other thing I wanted to highlight here that's kind of interesting over time is the growth or the change as we look at where we are in terms of future debt levels over time. So, like 2007, then this 2008, over time it continues to march up. Where not only are we higher, but we're also anticipating it being even higher into the future.
Great.
One
Awesome.
way path. Both parties flip flop back and forth. We just continue to march on, spending more and more money, and heading towards like never land in terms of fiscal stability.
Well, we'll have to see what this does in the market. Just,
Yeah,
yeah, I don't know. None of this is sustainable in my eyes. The 200% number is if a lot of things go correct. And I
yeah.
don't think a lot of things are going to go correct.
the good news, Dylan, is that I bet you right now that 20-year puts are probably pretty cheap.
It's true. Yeah. Might buy some. All right, guys. Let us know what you think.
Get to the next one.